When we were kids, I bet you played that scratch-off card game at least once. The lucky ones might win a motorcycle or a car. The unlucky ones just got better luck next time.
And let's be honest, most of us were in the unlucky group.
As we got older, we found a game that's more thrilling, involves way more money, but feels exactly the same as scratching off a card.
That game, folks, is playing the stock market. Today, you and I are going to talk about stocks and the financial market for absolute beginners. We'll help you stop feeling overwhelmed the first time you enter this major league field. We'll help to amplify.
And I assure you, I am still very much a beginner in this game too. In this video, we'll cover stocks och nationaliteter av and var they're profitable.
We'll also break down how the stock market runs, who controls it, and what beginners need to know when starting out. Kill that debt and let's it start. I'm William. You can join the Williams Insights Facebook page via the link in the description or comments below.
You can also check out Top Crypto Community, a great group for learning and gaining knowledge in the cryptocurrency sector. You can also check out Top Crypto Community, a great group for learning and gaining knowledge in the cryptocurrency sector. When people hear the word securities or stocks, they often think of complex, highbrow concepts.
The key difference is that it comes with legal documentation, regulations, and a formal playing field.
For instance, the money you put into a commercial bank is called savings.
The money you commit to a major company is called an investment.
But lending money requires proof. If you don't have evidence, it's just a flimsy IOU. The word security literally means proof of commitment. And therefore, a security is documented proof that you hold the right of ownership to a specific asset.
In economic terms, it is a tradable financial instrument. Imagine a company as a giant, delicious pie. Shares turn you from an outsider into a shareholder, a part owner of the company.
You don't run anything, but you're now pooling capital with them. If they profit, you eat well. If they lose, you take a loss.
Or some companies will distribute a portion of their earnings to you, which is called a dividend. Unlike stocks, Vithi, a bond doesn't make you an owner. It makes you a creditor, a lender.
When you buy a bond, you are lending capital to the government or a company. When you buy a bond, you are lending capital to the government or a company.
They also promise to return the original principal amount at a specific date in the future. That predetermined return date is called the maturity date. That predetermined return date is called the maturity date. However, the trade-off is that they offer lower potential returns than equities. As I mentioned, both stocks and bonds are tradable instruments. Since they can be exchanged for money, they are essentially considered financial commodities. Logically, there needs to be a marketplace to trade and exchange these financial assets.
That place is called the stock exchange or stock market. But unlike a regular market, people here aren't buying and selling fish or vegetables. Instead, they are trading in belief and expectation.
Belief means the company will be profitable, and expectation means the price will rise.
They buy with the hope of selling higher to capture a profit.
In the US, We have major exchanges like the NYSE for large companies. Then there's the NASDAQ, which typically lists mid-sized tech and growth companies. Additionally, we have the OTC markets for smaller firms or those not yet meeting the strict listing criteria of the major exchanges. Exchanges create a diverse ecosystem for all types of companies to list their shares. Buyers on the stock market come from all walks of life. It's not limited to a single class.
To participate, you just need to open an account with a brokerage firm, which acts as the intermediary between you and the market.
In the US/EU, we have many popular brokerages, like Interactive Brokers Vice. IBKR is often compared to a cheap, highly convenient street vendor. It's affordable, fast, and heavily trafficked. It's great for beginners who want low transaction fees and a quick, streamlined experience. Then there's a brokerage like Charles Schwab. This is more like a well-established, reputable library or bookshop.
It has a long-standing, trusted brand and a strong team of analysts and research platforms. This brokerage is ideal for serious investors with significant capital. Suited for those who need in-depth reports, strategic consulting, and reliable guidance.
We also have brokerages like Fidelity. This is comparable to a convenient supermarket chain. It offers everything you need with a clean, user-friendly interface.
However, you often have to wait in line for customer service, making the process a bit slow.
It's perfect for those who want one app for investing and personal financial management, even if the app loads slowly sometimes.
Lastly, consider a specialist broker like Morgan Stanley. This is like an exclusive, established finance club. And it is definitely not beginner-friendly, but once you're established, you won't want to change. It offers highly detailed stock advice and a strong analytical platform for specialized investors. Their advantage is deep stock consultation, a strong reputation in specialized investing, and robust research platforms.
This is best for experienced investors who conduct in-depth research before making any purchases. It is absolutely not suitable for those who are just starting out. It is absolutely not suitable for those who are just starting out.
You should select a platform that perfectly matches your specific needs and goals. New players should pick an easy-to-use, low-fee option. To play, you'll need ID, a smartphone with internet. A few minutes of registration is all it takes to get started.
Many people assume stock investing is only for the super rich. They can definitely move the goalposts.
But fundamentally, anyone can invest. One stock can cost as little as a few dollars. Opening an account is often free, and there is usually no minimum balance requirement. Opening an account is often free, and there is usually no minimum balance requirement. The market doesn't reject the poor. It rejects those who are easily triggered by emotion and impulse.
Because the more you invest, the larger the potential profit. However, alongside those profits, the risk also increases significantly. If you're new to this, start small.
You need to learn how to handle purchasing, winning, and losing while maintaining emotional calm. People often say the market is a living organism.
It also reflects the market's current mood or facial expression.
By understanding this, you can avoid recklessly throwing your money around. Some key indices a newbie should know are the S&P 500 and the Dow Jones Industrial Average Press. The DJIA is similar, reflecting the price movements of 30 large companies on the NASDAQ. Similarly, other indices cover mid-cap stocks and different market segments. We also have indices like the NASDAQ 100, which tracks the 100 largest, most highly liquid, non-financial companies on that exchange. These indices are not the individual financial metrics of a single stock. They are the collective temperature reading for a specific group of stocks as a whole. This is different from the fundamental financial ratios of individual companies. You may have heard of ratios like EPS, PS, TASH-E, PB, and ROE. These key metrics are used to scrutinize the detailed financial health of each company. If you have the time and the community supports it, I will dive deeper into each of these ratios later. A quick note, while they are all called stock market indices, each exchange will use a slightly different methodology to calculate its figure. It's like how every high school has its own unique grading criteria for students. For example, the S&P 500 is weighted by market capitalization cardist. Here's the general formula. This is a common, generalized formula used globally. The larger a stock's market cap, the greater its influence on the overall index figure. Brokerages and exchanges calculate and update these numbers for us in real time anyway. We just need to know the meaning to judge if the market is trending up or down. Let's move on to an interesting question. How exactly does the stock market work? And who ultimately is controlling or driving the direction of the market? In reality, it runs on the electronic trading board TRIEX. Let's take the symbol BAC as an example. In the middle of the board, there is a number called the reference price, REF, which is the previous day's closing price. For example, today, BAC's reference price is $25.10. Next to it are the ceiling price, the maximum price allowed today, and the floor price, the minimum price allowed. Each stock can only fluctuate within that predetermined daily limit. The ceiling price is usually highlighted in purple Agapas, and the floor price is in light blue mouse. If the price rises above the reference price, it's shown in green JJ. If the price falls, it's shown in red bats. No change is yellow. Generally, green means you're not shunned, and purple means you're respected. Looking to the right, you'll see the bid column, people placing orders to buy shares of BAC. For example, they might be placing orders at $25.15, $25.20, and $25.25. Next to that is the ask column go, which is exactly the same, but for sellers. These are the people placing orders to sell their BAC shares. Each row shows the specific bid/ask price and the corresponding volume of shares at that price. It's like two separate lines of people waiting to be matched up. If someone accepts the price of the opposite side, the order is executed. The center of the board shows the current matched price lens, which is the price where the trade was successfully closed. This is the exact price where the buyer and seller agreed to finalize the transaction. For example, if you want to buy 50 shares of BAC at $25.25 and a seller has the same ask price, order will be executed at $25.25 and the matched volume is 50 shares. Throughout the day, the stock price moves like a beating heart's graph. The board also shows three other critical numbers, starting with the highest price of the day. It also displays the lowest price, which may have dropped to $25.05, and the average price. There is another crucial column many are interested in, foreign trading volume arm dest.
This shows the Zokumi, the net volume of shares bought and sold by international investors.
There are two primary lines here. Net buy, which is a very positive sign. Other is net sell, which can easily shake market confidence. Net sell can easily cause the market's psychology to become unstable.
For example, if foreign investors buy 1 million shares of BAC but only sell 300,000, their net buy is 700,000
People will
shares.
instantly notice, look, the big foreign players are accumulating BAC shares.
By reading this board, you can clearly see the current state of the market right now.
I've summarized all the key trading board concepts and the meaning of the colors here, and feel free to pause the video to study them. However, the trading board only shows you what is happening right now. It absolutely does not guarantee that the trend will continue in the future. Here are the primary factors that cause the market to fluctuate every single day.
First, major utvecklingsrätt in production there are major news and macroeconomic policies. For example, new government laws, interest rate changes, like by the Fed, or global conflicts.
Any of these events will immediately cause market volatility. Any of these events will immediately cause market volatility. If revenue soars, the stock price will rise. If the company is facing major losses or a merger, the stock price will fluctuate dramatically in response to that news. Third, cash flow and investor psychology.
If an event occurs that sends a wave of excitement through investors, they will rush to buy,
and the price will inevitably rise as a result of that buying frenzy. This collective panic will cause the stock price to plunge dramatically.
One important thing to remember is that the market is the total sum of all its participants.
Since human emotion is involved, sometimes people's trading behavior makes zero logical sense.
They might be acting purely on a gut feeling or impulse. Not even a legend like Warren Buffett knows the market's direction tomorrow, but there are ways to read it. Not even a legend like Warren Buffett knows the market's direction tomorrow, but there are ways to read it. Choosing a good stock is like choosing a life partner. Nethwar et Davor. The only difference is that you can't sell your spouse.
Method 2, technical analysis. This is where you use price charts and various indicators to predict future trends.
This method is for traders who like to surf the market waves, jumping in and out of the price action. They are focused on momentum, seeing where the wave goes so they know when to sell. Method 3, cash flow and psychological forecasting. Oof. Let me be clear. The stock market is absolutely not an unregulated marketplace. It is title. It is title governed by law. Three key forces play a vital role in ensuring the market doesn't turn into an unregulated casino. Three key forces play a vital role in ensuring the market doesn't turn into an unregulated casino, as well as the regional exchanges, Equity, BEGE, NYSE/NASDAQ, and the brokerage firms themselves.
Simply put, if you want to trade, you have to go through them, them.
It is merely the surface level of how the market operates. Cash flow, taxes, and manipulative tricks to trick people into buying or selling, that's the advanced stuff. Cash flow, taxes, and manipulative tricks to trick people into buying or selling, that's the advanced stuff.
You have to be in the market for a long time before you truly start to understand those dynamics. You have to be in the market for a long time before you truly start to understand those dynamics. I'll research and make a dedicated video that covers these advanced topics in simple detail.
Okay, so we've covered the basics of stock market knowledge.
Now, here are some key things to keep in mind if you are a newcomer to the market.
First, investing is not about staring at the trading board all day long. Many people enter the market by just opening an app and getting fixated on the red and green flashes.
This obsession is like going to college solely because you saw other people flexing their beautiful diplomas. Investing shouldn't start with FOMO, these Jagd, Diezings. You need a solid fundamental foundation to ensure the market doesn't lead you blindly.
Next, understand the company first, and only then worry about the technicals.
Newcomers often get way too focused on all the different chart numbers and ratios.
How does this company make money, and is it sustainable? Is their business model essentially durable?
What is the company's core business? What are its profits and losses? How much debt do they have? Who is the leadership?
And what will allow this business to survive and thrive for another 5 years? Next, the market is less scary than your own emotions. In the stock market, the only thing you truly have to control is yourself. Then, as soon as it dips slightly into the red, you panic sell everything at a loss.
This emotional approach is not the right way to navigate a high-risk market like stocks.
You can control this by writing down your initial reason for buying each stock. This serves as a vital reminder when panic hits and you feel lost.
Don't check the trading board every minute like you check your weight after every single piece of cake you eat. Focus on the underlying company and its fundamentals, not the daily stock price fluctuations. The final key takeaway: sometimes you just have to accept losing money as a necessary learning cost. View their initial losses as a non-refundable tuition fee for the market.
Only invest money that you won't need for the next 1 or 2 years.
Never borrow money to invest, and never, ever play with money you don't fully understand.
And please, do not all in or blindly follow anyone's to the moon advice. Starting with $20, $50, $200, or $500 is a perfect way to test the waters and experience the market's volatility.
But stay sharp and be sober-minded.
Otherwise, you'll end up learning some very expensive lessons and potentially losing your house. In summary, the stock market is a place to make your money work harder and smarter for you.
If you don't understand it all immediately, that's completely fine.
You already know your starting point, understanding the board, the players, and the rules of the game.
I'm William, and don't forget to subscribe to the channel so you don't miss any of our videos.